Hey guys, this is Sean Waller, also known as Sean Your Realtor.
Yo!
Continue to educate yourself because this business is always evolving. Just continue to learn. With it. Talk to you guys later. Hello. What's going on, everybody? This is Sean Waller. Welcome back to the Strictly Free Game podcast. I have one of the living legends on Long Island, Quentin Hardy, the qualifier. You see the shirt. He's like Superman. He is the man. Listen, I'm not even gonna. I'll give a little background. So Quentin and I have known each other for a few years now. I want to say maybe like 5 years. Amazing guy. We always just kick it every once in a while. And he's always one of my go-to people when it comes to just family stuff, the business, anything I could think of. I know I can always reach out to Quentin to give me a little advice on that. So he's definitely one of the pillars to that for me. But I won't toot his own horn. I'll let him do that himself. So Quentin, give us a little background on yourself, sir.
Sure. I am in the mortgage industry for 17 years. Married, one wife, 2 children, 27 years married, living on Long Island for many, many years.
Nice.
Am I allowed to say company names or you want me to leave that out?
You can say company names, of course.
I had a 13-year career at Wells Fargo, and I became the #1 renovation loan specialist in the nation. And I know that's part of what you want to talk about is renovation loans. So I figured I would give my credibility. And I don't know about most people. We can't say there's a lot of spots where we've been ranked #1 and recognized as. So if I'm bragging, yup. #1 in the nation for several years. So that makes me one of the top people in the country in that particular field. And when they shut down the program in 2017, I came to where I am now, Movement Mortgage. Great lender, like working here. And I became the #1 renovation specialist in the country for Movement as well. For each of the full years that I was originating loans. So yes, that is my area of expertise. I do more than just renovation. However, I was a renovation specialist. So from 2011 till 2017, that's really all I did. Now, once I left and went to Movement, I've opened it back up to everything. So I work with a lot of first-time home buyers and I still do lots of renovation loans, but a lot of first-time home buyers. So yeah, lending everything. I think that's what you wanted to know. And I don't know if you saw the post today, but I was actually kind of proud. Scotsman's Guide just ranked me in the top 2% of mortgage lenders in the nation.
I saw that. I was actually going to ask you about that.
Yeah, I thought that was kind of cool.
Quentin is the man.
My numbers hadn't been reported before, so Scotsman Guide never ranked me. So they have me as 1 year of experience. So if you look at the numbers, so I'm like, yeah, this is my first year, but it's really my 17th. But they have me as a top 2% in the nation for mortgage lending. So I'm happy and excited about it.
Well, you notice you still look like you're 25 years old, brother. So they can't believe you've been in the business for 17 years. That's what it is.
Well, let's say I'm 25. Let's stick with that. My oldest son is 24, so
that
would be kind of hard. Well, I'm old enough to be your dad's cool younger friend.
Yes, definitely. Quentin is the man to hang out with. He's probably in better shape than most 25-year-olds I know anyway. But we'll get into that stuff as well. So speaking of the renovation loans, let's give a little background on it. So we're talking about the 203K rehab renovation loan. Mm-hmm. Just give the audience a little background on exactly what that is.
Sure. The 203K is one type of renovation loan. I'm going to use the more global term renovation loan. 203K is a lot like Q-tips. If you go to the CVS and you buy CVS brand cotton swabs and you take them home, you still call them Q-tips. So the phrase 203K actually refers to an FHA renovation loan. There's also a conventional version. There's a VA version. So there's different kinds. They almost always get called 203K. But the bottom line is the main thing is that a renovation loan is looking at the condition and value of a property as if it's already been renovated, as if it's already been rehabbed. So that means someone could theoretically buy a 3-bedroom ranch, but when the appraiser comes out to see it, they have the bid from a licensed contractor and the plans from an architect, and the person, you're converting it to a 5-bedroom, 2-story colonial with an extended great room and a new kitchen. Mm-hmm. They'll now give us the value as if it was this new version, And then it allows the person to go ahead and buy the house as a 3-bedroom ranch, close on it, and now convert it to a 5-bedroom stories with an extended great room and a kitchen. So it works really, really well for people who are buying foreclosures, short sales, distressed properties. Right now, if you're looking in inventory, older homes that need updating. So for anybody who's ever seen the Property Brothers, you know, they have those twins where one's a realtor and one's a contractor. They never talk about the financing, because they always say like, oh, well, you've been pre-approved for 400,000, but the house only costs 300, so you've got 100,000 left over to do work on the house. But we all know if you go to the bank and say, can I borrow 400,000 to buy a $300,000 house? The bank said that's not how it works.
Yeah.
In reality, that's exactly how a renovation loan works. So sometimes that's the joke, is that I'm the property brother, because there's two property brothers, but clearly there's somebody else with the financing. So that's what I do.
Nice. So, well, I'll backtrack to that because that's interesting. So on that show, do you think they're actually going for rehab loans? Is that how they actually structure and everything on the back end?
Yeah, actually, if you go to my Facebook business page, where I guess there's a link below for it. I don't know if you're going to do that, but if you do, it's a link.
Of course, we're going to put the link.
There's actually
links everywhere.
Good. There's a picture of me with the Property Brothers. So I did get to meet them, and you know they insisted on taking a picture with me. So I said, "Okay,
you're a superstar, man. I'm telling you, you're a superstar."
But the bottom line, yeah, they were very familiar to it. Now a lot of that show is filmed in Canada, the first few seasons, so it's a completely different thing. But the ones that are filmed here in the United States, yeah, they use renovation loans.
Wow. Okay, that's good to know.
203K home style conventional renovation loans, different kinds of renovation loans to do the work. That's exactly what's happening in that show.
Yeah, because it can be very confusing watching the show. You would never think that. People think I always thought they were just pulling equity out of the house to do the renovations. I never even thought about the renovation loan.
Yeah, because those people are buying it, so they don't have any equity yet. So those are renovation loans.
That's true.
To me, I see it as a show about renovation loans that never mentions
the renovation loan. Yeah, that's definitely something that's missed in that. Wow. Okay, so the renovation loan, right? So now we're noticing this is nationwide. There's no inventory on the market right now. Very scarce. So I think renovation loan would be a great vehicle for a lot of first-time home buyers, a lot of people that's even, looking to upsize their home, to get a little more skin in the game, right? So just to backtrack, what Quentin was saying is that you could find a property, right? That's, say the property is $400,000 and there's an additional $50,000 that's needed in renovation. You could get this loan that's going to cover the additional $50,000. Right. Okay. But the property has to appraise for that value.
Well, the property appraises as the as completed version.
Mm-hmm.
So again, if you bought a $300,000 house and you're doing $100,000 worth of work, will it appraise for 400? It could. There's also a little caveat in there. Not all of the renovation loans, but the 203K has a very special feature most people don't know about. We can actually lend 110% of the as completed value. So follow me on this.
Yeah,
you find a house for $400,000.
Okay.
You want to do $100,000 worth of work. That's a $500,000 package deal. That's how the bank sees it. Mm-hmm. You can put 3.5% down on the 500. But let's say it only, as a matter of fact, let me grab my calculator. So 400 to buy it, 100 in renovation. We're going to say that's a $500,000 package deal. You put down 3.5%. So your loan is going to be 3.5%. So you're going to put down 17,500, and your loan will be 482,500.
Okay.
But let's say the house only appraises for 450. You're like, uh-oh, I can't get a 482 loan on 450. Well, actually, what we're allowed to do is lend up to 110% of the as completed value, which is 495 on 450. So you could actually get a 482 loan on a $450,000 valued home. Because with the 203K, we recognize that some of the renovations may not add equity or value to the property. However, 203K actually has a lower default rate than other FHA loans. So whenever someone says, well, you guys are lending over 100%, yeah, but if it has a lower default rate, clearly it's justified mathematically from banking. It's worth it. So yeah.
When you say a better default rate, so you're noticing that there's less
lower default rate.
Yeah. Wow.
Because that's usually the concern. You're lending 110%. these people can get foreclosed. No, it's actually a less risky loan than a regular 3.5% down FHA.
Wow, interesting. But you don't only have to go FHA. You could do conventional as well with a rehab loan, right?
Yes, the conventional does not have that extra 110% feature, however.
Only the FHA.
Only the FHA. So if someone is, if you're afraid that it's going to appraise short, I actually had this. Now this is more realtor specific, but I actually had a transaction. This was years ago. It only happened a couple of times. I only had this happen a few times, but this was a few years ago. Let's say the person's buying the house for $400,000, and short appraises for $385,000, and they don't have $15,000 to make the difference. Now with FHA, the appraisal stays with the property. But this particular person, she's like, my sister lives right next door. I'm not concerned about that 15,000 gap. I still want the house. So we explained to her, we asked her, what do you need to fix in the house? Because it needs a new kitchen. How much is the new kitchen? About $25,000. I said, all right, add the new kitchen, give me a bid, and we'll get a 203K appraisal. Now the house appraised for still not quite the 400, but because of the 110% feature, we were able to get a loan big enough that she didn't have to bring extra money. She bought the house, even though it's short appraised, and she now had the new kitchen. So she was happy that it's short appraised because she said it actually worked out better.
Yeah, it worked out better for her.
Right. So I have had people switch to the 203K exclusively and specifically for that 110% feature, just because it allowed them to get something they want.
Yeah, wow. And I'm glad you actually mentioned that, because I was going to go into that. The 203K, that it doesn't mean that the house is a total renovated house. Like you use it for the bathroom, kitchen.
No, I've had, yeah. What's great about the renovation loans in general is that you can do the loan regardless of property condition. So if it has, no roof, broken windows, exposed asbestos, black mold in the basement, if it was a burn down, as long as the fire is out, we'll do the loan. If it's still smoldering a little, we're okay, but make sure the fire is out. Nuclear waste in the basement, we don't care, because we're not concerned about what it is, we're concerned about what it's going to be. So the condition is irrelevant.
Okay.
By the same token, it need not be in disrepair. So I have had people who, like I said, they bought a 3-bedroom ranch, because when you buy a house, what's the thing that they say for real estate? Location. Mm-hmm. So if you buy the location, you can do anything that you want to the house. So the house might be in perfect condition, and you can still renovate it into whatever you want it to be. So I have had people buy a 3-bedroom ranch and convert it to a 5-bedroom colonial because they wanted the school district and they couldn't find the house that they wanted. Which I guess that links back to something you said earlier. You talked about inventory. Right now, inventory is really tight. Mm-hmm. So using the renovation loan is a good strategy, because let's say a person, they're looking for homes in the $500,000 range, and they've looked at everything that's in the neighborhood. They made offers and they lost all the bids. Mm-hmm. Maybe start looking at those 450 houses that need work. Yeah. Go look at the 425 house that's in that neighborhood that needs 50, 60,000 in work, mm-hmm. that everybody's walking away from because they think it's ugly. Find that house with the nasty kitchen and the busted up bathroom. Yeah. As a matter of fact, the house that I live in now, years ago, my wife and I, we moved, and school district was the thing we were moving for. So I told my wife, find a house you do not like in a neighborhood you do like. Mm-hmm. And she found that she liked this school district. She liked it. And we found a short sale. It had been vacant for 3.5 years. The people had some financial issues beforehand. So they hadn't opened the pool for like 3 years before they before they moved out. Oh. So the pool was in disrepair and broken. And she had every floor redone, every wall redone, all new doors and door frames and new ceilings. So that's all the surfaces in the house. Mm-hmm. New kitchen, new bathroom.
It was a brand new house.
The day we walk in, brand new house. We even had the pool repair. We have a gunite pool, which was cracked. So we had the mm-hmm. gunite fixed, redone, new bricks. So so the day we walked in, new house.
There you go.
So we've been here for 10 years and we haven't had to do anything new since.
Yeah, she was actually able to design the house that she wanted too, right? She got the finishes that she wanted, all that good stuff.
Hey, I'm married for 27 years.
Happy wife, happy life, is as they say, right?
Brother. Everybody knows it. Give her what she wants. So
But now the most important part.
It brings another thing. And I know you got questions. I keep talking, but this is something else to think about. Okay. Most first-time home buyers don't think about the fact that when they buy a home, they're probably going to spend about 10% of the purchase price over the next 18 to 36 months in turning that home into their own. Mm-hmm. What I mean by that is you find a house for $400,000. You're probably going to spend $40,000 over the next 2-3 years. we just need to fix the cabinets. I get some new windows over here and do the floors. But the challenge is that extra 40,000 or extra 10%, they don't think about it when they're buying for 400. They're really buying for 440 over the next 2-3 years. But that extra 40,000, what do they do with it?
I could testify
you did the same,
because
right?
we did the same thing when we purchased our home. We did. I had no idea about the rehab loan, and we purchased the house. It was dated, super dated, and we bought the house for cheap, but we wound up putting the money into it out of our pockets. So, and I think so far we've been here 5 years, and I may have put like $50,000 into the house already. Yeah.
There you go. That's the 10%. Now you said out of your pocket, which is good. Most first-time home buyers, they don't have the extra. So that extra money is they go to Home Depot or Lowe's and it's a credit card at 0% interest for the first 45 minutes. Then it goes to 17% by the time you leave the store.
Yeah.
So they finance it. So rather than get 17% on a credit card, roll that 30, 40, 50, whatever, roll it into your mortgage.
I notice a lot of people just don't know about the product. I think that's one of the, because if you walk into a bank, they never even present that to you. Most banks don't even put that out there that's an option for you.
Well, I left Wells Fargo in 2017 when they shut down the program. They went pure vanilla, and they're one of at that time they were the largest direct consumer lender, and their platform no longer allowed for niche products. So they went pure vanilla. They got rid of reverse. They got rid of construction of perm. They got rid of renovation loans. And they just went pure vanilla. And Bank of America used to do 203K years ago after they bought Countrywide, but same thing, they went pure vanilla. When Washington Mutual used to do it, they got bought by Chase. But nowadays, if you go into any of the big banks, the Chase, Citibanks, Wells Fargo, Bank of Americas of the world, none of them do the renovation loan. So of course, if you ask your loan officer at a bank that doesn't do it, it's like going into the BMW dealership and asking about Mercedes. They're not going to sell you on it. They're going to go, you don't want to do that. So I have people all the time that go, I spoke to my banker. He said that's a bad idea. They take too long and they're really expensive. I go, oh, does he do those loans? Well, no, he doesn't. He's a commissioned employee. Do you think he's going to tell you to go to his competition and get a product he doesn't have?
Exactly. And I was just about to ask you about that. So do you think, what is the timeline from beginning to end for just the process of going through the process of the process of actually applying for the loan? That's the word I'm for. So from beginning to end, how long does that usually take?
It should be the same as a standard loan. I've closed 203Ks and other renovation loans in 16, 18, 21 days. Now those are the records. They don't all go that fast, but I will tell you the thing that typically takes long and the thing that is the delay is getting the contractor. Because look, I think about it this way. When you're buying a house, you're going down two different roads at the same time. One road is getting the homeowner or home buyer approved based on their income, assets, credit score, showing that they have the ability and likelihood to repay the loan. Bank likes that. Great. That's an acceptable risk. Then we want the acceptable risk on the collateral, the home itself. We don't want to lend $400,000 on a $300,000 home. We don't want to do a loan on a house that you can't live in. That's too risky. So the appraiser is going to say, yes, it's livable. Yes, it's stable. Yes, here's the value. With the renovation loan, the only thing that's different is the appraisal is now based on the as completed value. So when the appraiser goes out, we need the plans from the architect if you're making architectural changes, and we need the bid from your licensed contractor for whatever work that you're doing.
License. Keyword is licensed. Keyword is licensed.
Well, the keyword, let's even say legal. We don't, like if somebody says, oh, do you guys require a license? No, we don't, but the local municipality does. The county does. And then, well, the guy's, he's licensed in Nassau. Is it okay if he does work in Suffolk? I said, that's actually illegal. And we just can't be involved in anything illegal. And people, oh, come on, it's like driving 56 miles an hour. But, well, we can't break the law. We're a bank. So we don't require the license. The town does, the county does, the state does. So whatever legally you need, that's what you need.
Yeah. So your father-in-law can't do
another direction.
He's handy. He's handy. Your father-in-law can't come in and just do the work for you. You can't put it.
If he's licensed.
Well, yeah, if he's licensed.
So you can hire him. You can hire him like anyone else. But yeah, oh, but right. But the thing that can slow you down is not having that contractor. Because normally, as a realtor, when that contract goes up, what do? You call that person's loan officer when you are in the appraisal.
Yep.
Now, when you call me and say when you are in the appraisal, as soon as we get the work bid. And now if the home buyer says, oh yeah, my contractor, he's going to go out next week. Now we're waiting a week. And then the next week, oh yeah, the girl in the office who answers the phones got COVID, so he had to go to the office. So he says he'll go to the house next week. Now we haven't ordered an appraisal for 2 weeks.
Mm-hmm.
Then he goes the next week. Oh yeah, he saw the house. He's going to get us a bid next week. Then he gets us a bid. So now we've waited. We could have been closed, but it took you 4 weeks to get me a work bid. So whenever I have people who are doing, I tell them that's the number one thing. Get a contractor lined up ahead of time. And when you get your offer accepted verbally, don't wait for contracts. Have your contractor go in and give you a work bid as soon as possible. Because the bottom line is, if I ask the homeowner for a pay stub or a driver's license, they can send me that in 24 hours or less. But if I ask them for a work bid, they're at the mercy of someone else who may or may not have the same sense of urgency that the home buyer, the mortgage lender, the realtor, the attorney, and the title company have.
Yes.
Realizing a mortgage and a home purchase is a team sport. But if you get one person on the team who's not playing, it doesn't matter you got LeBron if one of the players doesn't show up.
That's true. That's true. So from the contractor standpoint, right? We're talking to the contractors now with the rehabilitation loan. What exactly do they have to put in this bid for the bank, right? Like it has to be itemized, correct?
Yeah, it should be itemized and detailed. It needs to be clear so we can understand what's going on and what it costs. And as far as the bank is concerned, if the house is distressed, there's basically three things at the bank, three categories that the bank is looking for to make sure the house is livable. And I always explain this to people who are buying all the time. Number one is utilities, water, heat, electricity, and gas. Are they on and operating? If not, you gotta address those in the work bid on how they'll become operable. Number two is health and safety. Do you have any black mold, exposed asbestos, broken windows, trip and fall hazards, exposed electrical wiring, windows where someone is broken, that someone can get cut? Any sort of safety issue that's got to be resolved in the work bid. You don't have to do it. You don't have to fix anything before closing. Just the work bid has to address it. And lastly would be completeness of the home. Are you missing sinks or tubs or fixtures, missing windows, boarded up windows, leaky roof? Things are gone or missing that you would generally expect to be in a house. That must be addressed as well. I had one where the house had no doorknobs. And we had to, I know, that's what I thought. It turned out they were all in the garage, and we just had to reinstall of existing doorknobs. I had one, this was a weird one. It was a beautiful house in Roslyn. Everything was great in the house, except all the toilets were gone. And we had to do a renovation loan. And the buyer said, this is just a few $100. Because yeah, but there's no toilets in the house. It's not, have you ever been in a house that has no toilets? It's not a completed house. And the bank won't lend on a house with no toilets. Apparently the people got foreclosed on, they took their toilets with them. I did not know there was a big market for used toilets, but these might have been really expensive toilets. I don't know.
I've had a foreclosure where I had a situation where the house was going into foreclosure. The seller took the entire kitchen out. Like literally cabinets, plumbing, everything. They took everything out.
Yep.
And I wish
sometimes people they take out what they can, they sell what they can, and then that's great. That means I can do the loan on it.
Yeah, and I wish I knew about this loan then, because this was right before we met, because I would have had a different approach to selling that property. It took me almost a year to sell it because I couldn't get a buyer, and the buyers that were coming in, no one knew about this product.
Yeah, when people ask me, because when I do a lot of renovation loans, they say, what's your biggest competition? Who's your biggest competition? And I say, without insulting anyone, my biggest competition is ignorance, meaning that people just don't know the loan exists. And the one who knows it exists, they don't know anything about it or how it works. Yeah. So hopefully your podcast is helping a bunch of people who are like, oh, including realtors. I mean, you learned something new about the loans today.
Yeah, right? This is in my utility belt now. I'm going everywhere with it.
Yeah. That's how it's explained to people how you use it. It doesn't work on every property. You don't need it on every property, but it's a tool in your toolbox that you need to pull out for the right thing. Have you ever tried to use a butter knife or a screwdriver? At one point, we've probably all done that. It's just nicer to have the right tool.
Yeah, I've done that a few weeks ago. You ever tried to open up a kid's toy? Put the batteries in. You can't find your screwdriver. That was me a few weeks ago. All right. Well, I'm glad you were able to really break down how this rehabilitation this rehab loan works, because I really, really, really think it's a great tool. And you can use it on. Can you use this on a multifamily, or is this only for single family residents?
Great question. You can actually, the FHA 203K, you can use on a 1 to 4 family with 3.5% down.
Wow.
And it's 3.5% down of the purchase and the renovation. So if you found something for 500,000 that needed 300,000 in work, you could do 3.5% down of 800 grand and buy it and fix it, renovate it. Exactly right. Now the conventional, you can still do 1 to 4, but you are required to do a bigger down payment on 15% down on a 2, and you're going to do 25% down on a 3 or a 4. If you're doing
Would you need reserves with that as well? Or do they require reserves?
The conventional, well, any of the 3s or 4s, you're going to need some reserves as well.
Okay.
Now the conventional does have a 3% down if you are a first-time home buyer on a 1 family. And then now you do have to have good credit for that.
I was about to ask about that. What is usually the regulation?
203K, you have a 580 credit score.
Really? Wow.
Yep.
Okay.
Yep.
All right. I didn't know that. That's good to know. All right. So yeah, I'm glad you broke that down. That's amazing. I know a lot of people want to get a good grasp of this now. But let's get back into Quentin. So like I said, you're like the marketing guy, right? Every month I receive I'm bringing it out, bro. Every month I receive one of these magazines from Quentin. You see that handsome guy on the cover? It's like he's like the Oprah of this is like the old magazine of of mortgage professionals out there. But I love it, man. I get a lot of tips.
You got the back, you got my there's the cue.
I'm telling you, this guy's a marketing genius, man. This is amazing. And it's a lot of great tips in here. So you give tips for content creation. You give tips for this for realtors. You give tips for it's mostly for like realtors, I think, right? I don't think I really see because this usually goes out to your realtors.
Yeah, I know there's one guy, I won't say his last name, but there's a couple of contractors I work with. One's named James. I told him it's really for realtors. He goes, I can use it though. This stuff is good. And he actually gets it. So
good.
Except for 1 or 2 contractors, for the most part, it is realtor specific. I'm the publisher. I'm not the author of this. So it's actually a team of movement mortgage coaches. And this is what they look like on their cartoon characters. This team of people write this publication that I publish each month and send out for free to any of my realtor partners. So if there's anybody listening to this who is in real estate, reach out. There's no obligation. It's not like if you send me a deal, then I'll send you this. I'm happy to send it out. It's just another way of, a rising tide lifts all boats.
Mm-hmm. And I look forward to them every month, to be honest with you. I get so many little tidbits from it as far as like my social media stuff that I'm doing now. I'm like, oh, I can use that. It's actually a really good idea. Apps in here that you could download to create your own memes. Am I saying that right? Memes, right?
Yeah, memes, yeah.
I always get mixed up.
If you're a full-time real estate professional, if you get one idea a month, and you'll get more than one, but if you only put one idea a month out of there, that's good. Then you've been helped. Because you have to do a lot of your own marketing.
Mm-hmm. So how are you doing as far as your social media journey? What is Quentin? What's your bag of tricks right now?
I don't have any special tricks that you haven't seen or know. I'm just continuing to grow and get better. This is actually one of the things I'm working on now, and you're probably going to mention this in a minute. But I know you are acutely aware. This is actually the week. 1 year ago this week, I published my very first book.
Wow.
So I'm a published author. And the first book, as you know, was A Guide to Becoming a Homeowner for African Americans. Yes, it is different for us. It's available on Amazon, but I send it out to any of my clients, anybody that I'm working with as a free thing. And the second book is How to Be a Superhero Home Buyer in the Long Island Market. So those are big parts of my marketing. And again, since I work with a lot of first-time home buyers, I think these are excellent resources. And it's been confirmed by some industry experts like my mom, my wife. So, if they say it's good, they're not biased or anything.
Not at all. They will tell you the truth before anyone else will. No sugarcoating with that. They would definitely tell you the truth.
My mom said it was good before she read it. The third one should be coming out. And the third one, you're going to be very interested in. The third one, I already got the cover up, is called How to Buy a Foreclosure Like a Superhero. And it's going to get a lot into the renovation lending. And I want to do it just in time because there's basically a foreclosure moratorium. So we didn't need it this year, but we're going to need it in the next couple of years. So that's the third book that's coming out.
I'm going to need a few copies of that. Actually, I actually give this book to all of my first-time home buyers, no matter what. I give it, and I've sent it to family members that I'm trying to get into. That's going to be another segue, but we have to start building wealth with our people. We do.
That's a big part of the motivation for the book.
Yes.
And then I'll share one of my favorite statistics when I was researching for the book. And I ask homeowners this all the time. I said, look, if first timers, if I were to tell you that the average homeowner has a higher net worth,
I was going to get into that,
than the average renter, you would not be surprised. And they would say, oh yeah, of course not. That makes sense. The average homeowner, higher net worth. How much higher, according to the Federal Reserve, how much higher is the average net worth of a homeowner versus a renter? Is it double? Is it triple? Is the homeowner worth 5 times as much? And no one ever guesses. It's 44 times. 44. The average homeowner has 44 times the average net worth of a renter. And this is according to the Federal Reserve. Mm-hmm. Those are solid statistics. But sometimes part of the thing we do get into in this book is the wealth gap. And a lot of it is actually a home ownership gap.
Mm-hmm. Now, this is a statistic that I actually saw.
You got to encourage them to buy, own.
There's a few things. So I always encourage everyone to buy, right? At some point, we have to get out of that mindset of renting because it's a road that you would lead yourself down for decades and decades. And when we don't live forever. And when we pass away, we're not leaving anything behind that's helping those behind us to generate wealth, right? That's one thing. And I always see people say, well, buying a home is not really an asset, it's more of a liability. It could be, right? It could be, depending on what you're doing. If you're purchasing smart and you're not exceeding your budget. We all know what our monthly budget is. Some people exceed it and they know that they're going to do it. Stay below your means, right? Stay below your means. And I'm also noticing that there's no such thing as starter homes anymore. I feel like everyone wants to go from mommy's house to the mansion. Like there's no in between anymore.
Right.
And you have to start somewhere.
I get into that in the book. You're better off owning a busted house in a bad neighborhood than renting a nice house in a nice neighborhood.
Mm-hmm. Correct.
It's between being an owner or not.
Mm-hmm.
And I always tell in the book, I mentioned my story is that I bought my first home, my wife and I, in 1998. So it's a long time ago in Freeport for about $160,000.
Wow.
But 5 years later, we sold it for $320,000.
Amazing.
Now, there's nothing that I could have done with the amount of money I was earning at that time to have increased my net worth by $160,000 in a 5-year period. And that's not taxable because it's not income.
Mm-hmm.
So that $160,000 we now rolled into the next house, and then we took some of that equity out and bought an investment property, and then we rolled that equity from that house into where we live now, the third house, and did the renovation. But it all started, and now we live on an acre, in-ground pool that we fully renovated. But it all started because we bought that first house. I never rented the whole time I've lived in the United States. I lived overseas for a while. We rented there, but in the United States, I've never rented. But a big part of it was because my parents pushed us. My wife was pregnant at the time when we bought that first one. Well, actually, no, she already had the baby. We came back and we were in the United States. We were living with my parents, and I said, look, we can't buy a house. We're not finding anything. We need some more money. Like, no, you're not going to rent. You're going to live here, have the baby, save the money, and buy. You're never going to rent. And I thank my parents. In hindsight, what a big move that was.
Yeah.
And granted, like you said, no starter homes. Where we lived, we had only one car. Date night on Friday night was we went to the Freeport Public Library because VHS tapes of The Sopranos were free. And that was our Friday night date night.
Mr. Romantic. See, I can't keep up with this guy. That's
that's broke romantic. I wasn't romantic. I was broke. I didn't have any money. I couldn't take her anywhere. That's why we had one car. We had no cable TV. So we couldn't even stay home and watch Netflix or cable. What we did was I had to go get a VHS tape from Freeport. Hopefully it was the episode that we needed next. Sometimes it wasn't. But we did that. But 5 years later, we moved to a new house, new neighborhood, better schools.
My wife and I rented for 1 year after we got married. And I was a property manager at, these luxury buildings. I'm not going to name any companies, but these luxury buildings, the rents are crazy. I actually worked there and they gave me a discount. I got a discount on the rent. I had a 1-bedroom apartment, 830 square feet, and I was paying $1,900 a month with a discount. It didn't include utilities. So I paid electric, gas, water. They charged me for parking. So when we were all done with them, and we had cable, when we were done with everything, we were close to $2,500 a month for a 1-bedroom apartment. We said, no, it doesn't make sense. We moved out of that apartment, moved in with my mother-in-law for, we said it was going to be 15 months. That didn't last too long. Last closer to 10 months. I love you, Mom, but that wasn't working out too well. But and then we purchased. It helped motivate us. Let's put it like that. It motivated us a lot. And then we purchased our own home, and my mortgage is less than what I was paying for that 1-bedroom apartment.
And over this last year, we've seen about a 10% appreciation on homes in the nation. That means if you bought a house a year ago for $400,000, it's worth $440 now.
Quentin, I bought my house for $250,000.
You made $40,000.
I bought my house for $250,000 5 years ago. My neighbor literally the neighbor in the back of my house is selling their house for $480,000, and it's not even as updated.
So $480 minus $250 is $230,000. You said 5 years, so you make $46,000 a year living there. Just by living there.
Just by living.
$46,000 a year. So you can subtract whatever you pay for mortgage and taxes, and you still made money. So I understand when people say, the difference between an asset and a liability. It's not exactly an asset because you're not getting an income from it, but it's not a depreciating asset, and it's not a liability in that regard. If you do it right, if your house is more than you can afford, then it's going to be a big liability.
Yeah.
But home ownership historically is where most Americans have the majority of their wealth.
Yeah, and we did the opposite. So we were pre-approved for way higher than what we purchased the house for, but we thought about our monthly budget. And we said, what? We never want to be in a situation where one of us loses our job, 2020, right? No one knew 2020 was going to happen, but if they lose their job, we can still cover this mortgage. One person could still cover the mortgage for a few months until we catch up. So that's the game plan we had, and it worked out. So now we're 2 kids in, we're outgrowing this now. So now it's time to get a little bigger.
When you say no one knew 2020 was coming, I always say I knew 2020 was coming. I didn't know it would be a pandemic, but I always tell people a storm is coming financially. And I do some coaching for people in their finances as well, aside from mortgage. But I tell them a storm is coming, whether it's a job loss, a hurricane, a house burning down, a pandemic. We don't know what it's going to be. But guess what, Sean? There's another one coming. I don't know when, but there's another one coming. So yeah, you do have to prepare your finances that way. And realize when you get pre-approved, whenever somebody calls and they say, well, what can I get pre-approved for? What's the bank going to give me? I would say, I'll tell you that number, but don't use that number. Use your own number, because the bank doesn't care if you're saving for retirement. The bank doesn't care if you have to go to the public library to get VHS tapes because you can't date. The bank doesn't care that you never take another vacation. And the bank doesn't care if you have to eat ramen noodles for the last week of the month because that's all you can afford. Yeah. So if you want to live that way, that's okay. That's how my wife and I lived for a few years.
Same here. We didn't even have furniture for the first year. We didn't even have furniture.
Right, but that was part of our 5-year plan. But after 5 years and a month, we were in the next house. So just know that. Don't go into it saying, how much can I get? It's a problem.
Let's talk about the pre-approval process, because a lot of people I think they're confused how it works. Someone's coming to you for pre-approval. What exactly is the bank looking at with this pre-approval?
The bank is looking to make sure it is an acceptable situation for the bank to lend their money. What's the probability of us getting our money back and getting it back in a timely manner? Well, there's certain things that they're going to look at. They're going to look at the person's credit score and credit history. Do you pay people back? So if you've got a credit history where, sometimes you do, sometimes you don't, well, they might still lend to you, but they might lend less, or they might give you a higher interest rate because you're a higher risk. So having the best credit you can is important. But I very frequently tell people, again, especially first-time home buyers, but a lot of move-up home buyers, people say, I've been pre-approved for a $500,000 purchase. No, you haven't. Understand that if you find a $500 house in Rosedale, Queens, and you find a $500,000 house in Valley Stream, the one in Valley Stream might have $1,300 a month in taxes, and the one in Rosedale has $300 a month in taxes. So the payment is $1,000 a month different. You might be able to afford one and not the other. So it's not the 500,000, it's the payment. It's all about the payment.
Mm-hmm.
And it's principal, interest, taxes, and insurance. So normally, let's say, for example, you're using an FHA loan. You can use 46% of your, I'm rounding these to whole numbers, but you can use 46% of your income to handle your housing payment as long as you do not exceed